We have a presentation from Linda Jeng. Linda is the CEO of ZentiPay. She's also a visiting scholar on financial technology at Georgetown Law. She will walk us through her recent paper on the treatment of consumer financial data and non-horizontal mergers. It was published as a working paper by the Bank of International Settlements. Linda, welcome to the stage.
I am delighted to be here. Thank you so much for inviting me, especially to present my very nerdy paper. I'm Linda Jeng. I used to be a financial regulator like many of you, and now I'm launching a stablecoin payments startup. So I'm in the market for good D&O insurance, for those of you in the room. But I'm here today wearing my hats as a visiting scholar at Georgetown Law and also as a senior research fellow at the Bank for International Settlements. And I'm here to present the insights from our recent BIS working paper, which I co-authored with John Frost of the BIS, Elizabeth Noble of the European Banking Authority, and Chris Brummer of Georgetown Law. Our paper, titled Consumer Financial Data and Non-Horizontal Mergers, very exciting, isn't it? Builds directly on the ideas that I explored in my book, Open Banking, published by Oxford University Press. Just a little shill there, where I examined how giving consumers control over their financial data can reshape financial services and how open banking is expanding into open data. My journey into open banking began nearly a decade ago when the Basel Committee on Banking Supervision asked me to chair their working group on open banking. That experience prompted me to leave the Federal Reserve and join Georgetown to work on what became the first academic book on open banking. As I immersed myself in the subject, I realized a critical gap in the literature. As our economy becomes increasingly data-driven, competition authorities still lack the analytical tools to properly assess the role of data in mergers. But the true catalyst for this paper came later, when the CVS pharmacy and Aetna merger occurred. I was genuinely surprised because I'm a customer of both. Aetna is my health insurance company, and I do a lot of shopping at CVS. So with both companies now under the same corporate umbrella, they can combine my purchasing power behavior with my medical data. That convergence raised a deeply personal and unsettling question. What happens when firms merge not just markets, but data sets that reveal intimate details about our daily lives? I even stopped buying potato chips at CVS because I didn't want my insurer to know. And to take it a step further, imagine a more dystopian scenario. I start buying ginkgo biloba supplements at CVS to help with my memory lapses, perhaps due to mommy brain. Aetna sees this pattern and flags it as a risk, raising my premiums for cognitive care. The merger may be non-horizontal on paper, but its implications are intensely personal and economic. That merger raised a critical question. What happens when firms consolidate consumer data not to gain pricing leverage, but to reshape competition through informational advantage? Open banking was originally a pro-consumer, pro-competition policy. It gave individuals the right to access and share their financial data with third parties. But we're now witnessing the evolution of open banking into something broader and more powerful: open data. As I argued in chapter 1 of my book, financial services are undergoing a dematerialization from physical branches and cash to mobile payments, wearables, and embedded banking in retail and social platforms. Financial data has become part of a wider open data ecosystem, intertwined with behavioral, health, location, and social media data. The implications are profound. Data is no longer just a byproduct of banking services, it is a core strategic asset. Firms that can combine financial data with other data sets can personalize offers, reinforce network effects, and raise switching costs. They reshape not just individual products, but entire markets. These developments expose a gap in how we analyze mergers. Many of today's transactions between a tech firm and a data aggregator, a fintech and a platform, are non-horizontal. They don't involve direct competitors or suppliers, but they still reshape the competitive landscape. The common thread? Data consolidation. Our paper explores several questions. When does control over consumer financial data become a source of durable market power? What are the competitive risks of consolidating such data? Are our current merger frameworks sufficient? And what remedies or oversight mechanisms should be considered? First, we argue that consumer financial data, when combined with other data sets, creates synergies that can entrench market power. Second, these mergers often don't lead to higher prices. Instead, they can foreclose competition through degraded access to data, preferential APIs, or exclusive integrations. Third, traditional tools like the Herfindahl-Hirschman Index, HHI, focus on market concentration and share, but they often fail to capture the competitive harms that arise when the primary asset being consolidated is data. These frameworks are built for measuring market structure in terms of output and pricing, not in terms of informational asymmetry or access control. But when data is the asset being consolidated, market boundaries blur, and harms emerge from exclusion, not price. Finally, we propose policy tools inspired by open banking itself, mandating access to key data sets, enabling data portability by the consumer, ensuring data segregation, and developing cross-agency frameworks between competition, financial, and data protection regulators. In the first chapter of Open Banking, I describe how data has become the connective tissue of modern finance. But what makes open data powerful is not just access, it's the economic logic behind it. Open data breaks down old silos. It allows new entrants to challenge incumbents, but it also introduces new asymmetries. Firms that sit at the intersection of multiple data streams can exert platform power across markets. That is the transformation we began to see with transactions like Visa's proposed acquisition of Plaid, MasterCard's acquisition of Finicity, and Amex's acquisition of Kabbage. Each of these deals involved firms expanding into adjacent verticals by acquiring access to vast data sets and consumer touchpoints. These aren't mergers about production. They're mergers about prediction, personalization, and platform control. They underscore the growing strategic value of financial data, not just as an operational input, but as a lever for dominance in emerging data platforms. This calls for an interdisciplinary response. Competition authorities, financial regulators, and data protection agencies must coordinate. We need merger review frameworks that are capable of detecting and addressing data-driven foreclosure. And we need to recognize that data isn't neutral. Its control shapes access, innovation, and systemic risk. To conclude, open banking is just the beginning. As we move toward open data, we need to update our policy tools. The BIS paper is a call to action to initiate deeper research into this underexplored domain of data aggregation and consolidation. It urges policymakers and scholars alike to rethink merger policy through the lens of data control and its implications for market power, innovation, and consumer autonomy. If we get it right, open data can empower consumers and unlock innovation. If we don't, it may entrench dominant platforms, restrict entry, and reduce choice. Thank you. Yeah, the first question is a really interesting one because supervisors, what information do supervisors need in this area where they might not be experts to protect consumers from negative effects? As I pointed out, this is an under-researched area. I'm hoping that our paper will actually help to drive more research in the field of data aggregation and consolidation. But I think it's important to assess what type of data sets each company has access to, and what could the potential effects be if these data sets were combined. The economics of data is fascinating. Data it's not like oil. Once you use up oil, it's done. Data is what we call non-rival. And so non-rival assets can be reused over and over again. It can also be used at the same time by multiple parties, and it can be combined with other types of data. And so this actually leads to very important policy questions and also important decisions for you all as to what are essentially the values that you want for the insurance ecosystems that you are not only regulating but helping to build and maintain. And then what would you suggest consumers do to reduce harms to them from open banking? Who has Venmo on their phone? Yeah, I think most of us do. So when you download the Venmo app, you're actually linking it to your bank account. And that is actually powered by a data aggregator named Plaid. So this is several years ago when I started doing research on the book. And at the time, the way to do linking between the bank account and Plaid was essentially for Plaid to take your login credentials and scrape your data. So when you are downloading the app, it takes you to what looks like your bank account, and you put in your login credentials, and you think, oh, I'm at Citibank, and I'm entering my Citibank login and credentials. But turns out that's actually powered by Plaid. So Plaid then takes and keeps your login credentials, and then it logs in later as yourself to screen scrape. The volume was so high that many banks said, stop doing this during the day, please do it at night. So Plaid started logging in and screen scraping at night. But as you can tell, most Americans don't realize that Plaid kept our login credentials to our bank accounts. And this raised some alarms, and there was a class action lawsuit, and also it ultimately led to regulators also looking to see, hey, can we share data via APIs instead? And that led to the CFPB's open banking rule that was adopted last October. But now with the CFPB being pretty much non-functional, it's really unclear what is going to happen with the implementation of the open banking rule. And if that's the case, then it's back to bilateral negotiations between banks and data aggregators, and perhaps less control by the individual consumer. So I used to tell my students, try not to connect to your bank account, connect instead to your credit card. But truth is, it's so ubiquitous now, it's not a practical piece of advice anymore. But we start to share data increasingly via APIs, I think this is something where regulators and consumers should push our banks and our financial institutions to share data interoperably throughout the ecosystem, not just bilateral connections between the individual 4,000 banks and the data aggregator. Rather, there should be a national, if not international, standard for API data sharing.